I think all this talk about gold revaluation is premature. I really do. Apart from anything else, we all know, I mean, the world's biggest open secret is that the US Treasury doesn't exactly have 8,130 odd tons, which it states it has. We have to really have a major crisis, collapsing the currencies before everybody's minds are focused enough to accept a solution. That solution would be a lot more radical than most people think.
I do think they'll revalue gold higher than most people think possible. But what they're really doing by doing that is devaluing the dollar. And hey, you can't make it up. It's called the gold revaluation account. It's happened 3 times before. Why not do it again? So with all due respect to someone who I think is the smartest guy in this industry, I'll just take a different viewpoint.
Recent documents suggest the Federal Reserve has been researching gold revaluation strategies, examining case studies from countries that have implemented similar policies. These studies analyze both the theoretical models and the practical challenges of implementation. Gold revaluation discussions exist within a broader context of evolving monetary systems. Throughout history, monetary regimes have transitioned approximately every 30 to 50 years as existing systems encounter their structural limitations. Leading global experts, Alasdair Macleod and AndySchectman, share contrasting views on the idea of gold revaluation. In this video, Alasdair Macleod contends that any discussion of a U.S. gold revaluation is fundamentally premature. He argues the government has never even conducted an independent audit of its gold. However, Macleod believes a full-blown crisis, a collapse in confidence in fiat currency, would have to come first. While others are skeptical, AndySchectman argues that a gold revaluation is on the table. He notes that every $4,000 rise in gold hands the U.S. Treasury $1 trillion. A revaluation to $24,000, as proposed by James Rickards, could net the government $6 trillion, effectively a soft default to support the bond market and reshore manufacturing as $28 trillion in debt matures by 2028. In theory, the U.S. could revalue its gold holdings, book those gains, and transfer them to the Treasury. It would be a windfall without new taxes, borrowing, or spending cuts. No gold would change hands. No vaults would be emptied. It would be a balance sheet adjustment. According to AndySchectman, the U.S. is quietly repatriating gold through J.P. Morgan to revalue it. He claims Trump once planned to issue gold-backed treasuries by July 4, 2026, as part of a coordinated global move central banks have been preparing for since 2016. Is this the real reason for the recent gold rush? Before we dive into Alasdair Macleod and AndySchectman's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I think all this talk about gold revaluation is premature. I really do. Apart from anything else, we all know, I mean, the world's biggest open secret is that the US Treasury doesn't exactly have 8,130 odd tons, which it states it has. How much it has, I really don't know. Before any gold standard could be contemplated, there would have to be an audit, a proper audit, an independent audit of US gold reserves. I don't see that happening. The other thing is that the system, both the Treasury and also the Fed, don't understand basic economics. They don't understand why money, corporeal money in the form of gold, is so important. It anchors the value of credit. They don't understand this at all. They're macroeconomists. They're not classical economists who, over centuries, work things out. That was all discarded by Keynes in 1936 in favor of governments manipulating our lives. So we're talking about climbing down completely from that sort of situation where governments actually have an awful lot of discretion as to what they can do with their currencies. I just don't see it. I mean, you know, it's people who think that this is going to happen. I think are people who fundamentally believe that things are under control of the government and government can just turn around and do things slightly differently. That's not the case. They really cannot. I mean, in this country, we've got a highly socialist government, and we saw not so long ago the Chancellor of the Exchequer, our finance minister, sobbing in Parliament over her predicament. And this is not a personal matter, which was the fact of the matter is that her Treasury officials will have told her that her first budget was an absolute disaster. They probably advised her against doing it, but as a union member, as a far left socialist, all this sort of schoolboy socialism type stuff, which these people have fed on. And they haven't been able to sort of pursue these fancies. She pursued these fancies and basically screwed everything up. So what happens? They found, you find that, the cabinet then has to try and come up with welfare cuts. And surprise, surprise, the parliamentary party, whose members are all elected to protect welfare payments and enhance them, refuse to go along with it. So the whole thing is just, a complete and utter mess. And the idea that with that sort of commitment to welfare states, that we can turn around on a dime and introduce new gold standards, forget it. It's not going to happen. We have to really have a major, major crisis, collapsing the currencies before everybody's minds are focused enough to accept a solution. That solution would be a lot more radical than most people think.
Well, I want to first start by saying I will often cite Alasdair's work, often credit him when I'm on with Dunnigan and others that he's the smartest guy in the industry. So I say this with respect, and I'm going to take an opposite viewpoint on this because I've been trying to think how we get out of this sticky wicket. I'll just cite two other things real quick before I jump into that. Michael Hartnett, analyst at Bank of America, came out just the other day and said central banks will be forced to revalue gold reserves to reduce domestic debt burden. Very positive for gold. And then Francisco Blanche, Bank of America Securities, says gold revaluation bullish for gold, showing it's no longer a barbarous relic but a key asset for central banks. Now even the biggest central bank of them all is taking a renewed interest in gold. So here's the deal. Every $4,000 increase in the price of gold would give the Treasury General account $1 trillion free and clear. Put gold at $10,000, they get $2.5 trillion. And that's the number that Mike Maloney came up with by using M1, dividing it into the money supply. Guys like James Rickards said 24,000, and he has another metric for doing it at $24,000. I want to suspend everything we know about logic right now and just say at $24,000, it would give the Treasury General account $6 trillion free and clear to work down their debt. What it would really do is devalue the dollar. Now, I want people to think about this for a moment. If Trump really does want to reshore manufacturing, which I do believe is a noble cause and must be done, 60% of this country has no college education. AI is going to eviscerate and kneecap a lot of white-collar jobs. We need to put people to work. But we have $28 trillion coming due, you guys, in 3 years in treasuries that are maturing. By 2028, we owe $28 trillion. We have a $3 trillion a year spending deficit, right? So that's another 9. 28 and 9 is 37. We take in $5 trillion a year in tax revenue. What the hell do you do there? You're halfway there. Not even. You're a third of the way there to what you owe. So my feeling is they're going to destroy the value of the dollar to support the bond market in order to bring back manufacturing. Let me explain. I do believe they will revalue gold. So here's what I'm thinking, and this is why I think gold will be revalued, okay? So we got the stablecoin bill that's going to run the front end of the market, the short-term treasuries. You got the Treasury Secretary saying, yeah, we can get $2 trillion a year in this or more. You get all these corporations selling stablecoins, so you get enough money to run the front end of the government. The back end of the the Treasury market, of the yield curve, will be, I believe, if you listen to what Judy said to me, she said, Andy, when I was on the transition team with Trump, and for those of you by now who don't know, Judy Shelton was Trump's nominee to run the Federal Reserve in 2016. She wasn't confirmed. Many think that she's in the running for this time, when Powell's tenure expires. But she said he told me in no uncertain terms that he would issue gold-backed treasuries on July 4th, 2026, the 250th anniversary of the country. So the first step would be to reshore all the gold. We become wicked, massive importers of gold, right? Okay, so you reshore it. I said, Judy, why hasn't it been audited? Well, it's going to get audited, she said. I said, do you know it's held in the gold revaluation account? That's the name of it? Yes, Andy, actually I do. Do you think it'll be revalued, Judy? Yeah, I think there's a pretty good chance it will be, Andy. Now, this is all on my video. You can go listen to it. She's been saying this again lately, but why would you do that? Let's put it all together. So the stablecoin runs the front end. Now, if you revalue gold, let's just pick Jim Rickard's number at 24,000. You're talking about a 50, 60% devaluation of the US dollar, right? How do you pay $28 trillion in 3 years? Devalue the hell out of the currency, you inflate the crap out of it, you softly default on the US dollar. We tell the world, look, and look what Vance is saying, it's not a privilege anymore. Triffin's dilemma, we got to bring back our manufacturing. How can we do it if we were the world reserve? Well, maybe we don't want to be the world reserve. Maybe what we want to do is devalue the hell out of the dollar, revalue gold. Who benefits who? Well, it certainly benefits us with all the gold we've been bringing back. Maybe to Alasdair's point, all this gold we've been bringing back and not telling anyone about, do you think that the only gold coming back is coming back through COMEX? Hell no, it ain't. It's coming back through proxy banks and to JP Morgan's vault, and there's so much more gold coming back than is just being recorded on COMEX. I guarantee it. So we bring all this gold back, and then we devalue the hell out of the dollar and revalue gold to a level that not only benefits us, but it benefits all the central banks of the world who have been accumulating in hand over fist since 2016 and 17.
Alasdair Macleod warns that it's not gold that's rising, but fiat currencies that are collapsing. After 54 years, the paper money system is buckling under unpayable debt. The evidence is everywhere, from central banks withdrawing gold from the Bank of England to open interest on COMEX shrinking as prices rise. A clear sign that a debt crisis is poised to expose a shocking shortage of physical gold. Since November 2022, the U.S. has flipped from being a net exporter of gold to importing over $100 billion worth. The unprecedented delivery rates at COMEX and the historic reversal of U.S. gold flows suggest we may be witnessing a fundamental transformation in precious metals markets. The continuous drain of physical metal from exchange systems, combined with record trading volumes against diminished inventory, creates an unsustainable mathematical equation. The paper market for precious metals is broken. AndySchectman emphasizes that, according to metals expert Bruce Ikemezu, physical platinum in London is nearly depleted. Alasdair Macleod and AndySchectman explain why an epic bear squeeze is underway in precious metals markets, and why the trend for gold and silver is much higher in the face of metals exchanges being drained of inventory and more big buyers standing for delivery. Let's get back to the interview.
The basic background is it's not so much gold and silver rising. Well, silver may be, but it's not so much gold rising as the dollar and fiat currencies losing purchasing power at an accelerated rate. So that's the background to it. So the idea that this sort of gold bull market is a bull market is actually misunderstanding the whole thing. What we're looking at is a bear market in dollars. And as we go into recession, I mean, we've already been in recession for about the last 2 years. I mean, if you take the budget deficit out of GDP, you can see pretty much how much GDP is coming out of the private sector. And the answer is a negative figure. So on that basis, you can see that there is absolutely no doubt that dollar is going down, and this will be reflected in far higher gold prices over time. You look at the technical chart, and I mean, it just confirms that, etc. So what actually we're talking about? We're talking about the death of the fiat currency system. That is dying. It's as simple as that. It's been running for 54 years. It's now coming to an end. And it's coming to an end because it's just created so much unproductive debt. That's all our economies, from governments and into private sectors, are just overloaded with this debt. They can go no further. We are sinking in a sea of debt. That is the other side of the credit bubble. For every debt, there is a credit. The credit bubble is it's the biggest one we've seen in history. It's far bigger than 1929. So we have this problem that when you get the death of fiat currencies, other things die with it. And obviously, one of the things that dies with it, the stupendously large derivative markets. Because, I mean, the idea of derivatives is you use them to hedge risk. But we now have a problem that the participants in that market are themselves greater in terms of risk than the risks which we use derivatives to hedge. I mean, we just don't want these counterparties. And that is an increasing problem. And we can see this in the case of gold. What happened earlier this year? Well, the Bank of England suddenly was shipping gold out, or, people who were storing gold in the Bank of England were shipping it out. There's a queue around the block to try and get it out. And the Bank of England was saying, it's going to take 6 weeks, whatever. The fact of the matter is that the Bank of England does store some gold for commercial entities, But the vast majority of the gold it stores is actually on behalf of central banks. And those central banks defray the cost of storage by leasing it. Now, under a lease contract, ownership passes under the terms of the lease entirely to the other party. So if you've leased gold, which is sitting in the Bank of England, and, the Bank of England has long been saying, well, don't worry, this is just a book entry. It just goes across to Charlie who wants to borrow your gold. And at the end of, next year or whenever the lease expires, we'll do a contra entry. And so it won't leave the vault. But it's left the vault. What this is doing is it's making central banks very wary of leasing gold. I mean, it's just quite obviously, it's the most stupid thing a central bank can now do. What do? They withdraw from the leasing market. And as those leases fall due, they're not being renewed. And I suspect in quite a lot of the cases, the gold is not being returned because it just simply is nowhere to be found. So under these circumstances, what we have is the shortage of physical beginning to impact on liquidity in the derivative markets. And we can see this on COMEX with open interest in the gold contract. Despite gold rising into new high ground and, doubling in whatever in the last year or 18 months, you'd think open interest would be 600,000 contracts or something. No, it's sort of only just above the oversold levels. I mean, basically, the squeeze has been on the system. And the same is true in silver. I mean, particularly in the last week or two, we've seen open interest in the silver contract fall while the price shoots up. What's that if it's not a bear squeeze? We've got it in platinum group metals.
What we are seeing will echo substantially from what Alasdair said, but we're seeing a draining of the world's exchanges, at least everywhere else besides the COMEX, which is getting filled. But there's some interesting developments. Last week, there's a man named Bruce Ikemizu, Ikemizu, and he was formerly head of Chinese bank ICBC Tokyo's Precious Metals desk, and now head of the Japan Bullion Market Association, kind of like the COMEX in Japan. He says the market may already be broken. He says London, to what Alasdair was saying, appears to have virtually no physical platinum available for delivery. He says it seems that there really is no platinum in local London, Zurich, yet continues trading nearly 3 million ounces per day of London promissory note cash contracts for immediate platinum ownership and delivery. Something is about to break, he says. But this is something that we're seeing all over the place. It's not just in London. We're seeing some really crazy, interesting things happen here in the United States as well. And I'll give you an example. If we just take a look, for example, at the first 3 days of the August contract. I've been screaming that we are watching these deliveries since November come in since the election that are ridiculous, that they're so far outside of what is normal. The people need to take notice that the people that are doing this are incredibly sophisticated and well-heeled. You do not see deliveries coming into the COMEX the way that we have been month over month over month since November and not take notice. Yet you don't hear a damn word by the mainstream. Okay, so the important things are ignored by the mainstream and are covered by guys like you and Alasdair and myself and others in this industry who spend copious amount of time trying to dig. The fact that we aren't hearing anything about this is crazy. We've become a net importer of gold since November. That's something that we haven't ever been in my 35-year career. Never, maybe a month here and a month there. Every single month, we're seeing massive amounts of gold and silver being brought into the United States. In the first 3 days of the August contract, we saw over 2 million ounces of gold post for delivery, over 20,100 contracts. Now, I used to say that less than 1% of contracts stood for delivery. During my career, that would be a truism. No one stood for delivery. These contracts were rolled over. These contracts were cash settled. It would be a way for producers or even a company like myself to hedge exposure. If I have 2,000 ounces or 5,000 ounces of gold in my warehouse, I will sell 5,000 on COMEX. If the price goes down on the 5,000 ounces of gold by $100, I'm down $500,000. But what I sold short on COMEX goes up commensurate. So it allows me to be market balanced, market neutral. I don't have any intention whatsoever of taking delivery of those contracts, but that is exactly what we are seeing. And to give you an idea, remember I said less than 1%, just within the first 3 days of the August contract so far, of the 20,126 contracts that were posted, 100% of those contracts, all of them stood for delivery. That's $7 billion worth of gold that stood for delivery. Now, this is what we've been seeing nonstop. What is also interesting is that the majority of that gold, goodbye, left the exchange.
Research from Kitco News indicates that the track record of successful gold revaluations is mixed, with some countries benefiting more than others. Other reports suggest it might be considered during a recession or near a presidential election to provide a short-term boost. However, the current focus is on other financial strategies. Politicians are warning you that an official gold revaluation is forthcoming, and the price action since Trump's election is telling the same story. Do you think gold revaluation is inevitable, or is it just speculation until confidence in the dollar completely collapses? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.